Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Wednesday, November 15th, 2023 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host here for the next 30 minutes or so as we take a look at the market action from yesterday, and maybe take a look into the day, what we might expect, look back at some of the news of today, and maybe even check out a couple earnings reports, that sort of thing. But I'm going to go ahead and jump in right away and get into the charts because I do have quite a bit to go over. So let me go ahead and pull those charts up for you. We are going to start with the Dow Jones Industrial Average, as we usually do. And as you can see, the Dow Jones Industrial Average rose 1.43% yesterday. That was up almost 500 points. The S&P 500 up 84. That was close to 2% higher. The NASDAQ 100 jumped 330 points. That was about 2.1% higher. Mid caps up 94. The small cap IWM Russell 2000 iShares ETF jumped 9.29 yesterday. That was 5.49%. Mid caps almost 3.9%. Transports big day yesterday, also up 3.3%. So you can see across the board, the action was very, very strong. One thing I noticed going across here, I mean, obviously the numbers were really good, very bullish, moving back up above the 50-day moving average now on the mid caps, the small caps, and the transports. And that joins the other three. We've been above the 50-day now for a while on the other three major indices. But one thing caught my eye yesterday was that big jump in the AD line on the IWM. Going into the session yesterday, if you were here for the show, one of the things I talked about was the IWM has had this history recently of most of its moves to the upside being gaps. And we'd seen very, very little follow through. And in fact, after we moved up the beginning of the month, you can see the IWM was selling off again. If you look at the NASDAQ, I mean, we jumped up the beginning of the month and we just kept going higher. S&P, same thing. Dow, same thing. Very distinct downtrend on the IWM after we had a couple of gap ups. So it just doesn't give you a real good feeling about those small caps being accumulated when you're just seeing gap ups and then followed by selling. And I think that was reflected in the AD line. If you look at the AD line on the IWM and the mid caps, you can see generally it's been down, down, down. And if you look at the Dow, the S&P, and especially the NASDAQ, you see a much different picture. It seems like those areas were being accumulated. IWM was not. And so that was one of my concerns going into yesterday was not only do we need to see the IWM perform well, but we need to see it outperforming and continuing to see rotation during the day. Yesterday, by far, was the best day we've seen in the IWM. Probably since July. We'll look at the chart a little bit closer in just a minute or so. But IWM clearly having a huge day yesterday. It was a Mirabozu candle. For those of you that are candlestick fans, that's where you open on the low, you close on the high, and it is just a trend day all day long to the upside. That's essentially what we saw on the IWM. We had a couple of small pockets, a little bit of selling during the day. But for the most part, it was just buy, buy, buy. If you look down at the volume, it occurred on massive volume as well. So really good day in the small cap area. Is it just a one-day wonder? Do we go right back down below the moving averages? Do we start to see relative rotation back away from it after just one day? Obviously, that would not be good for the IWM. So I am going to be monitoring this throughout the day. I did grow a lot more bullish yesterday on the IWM because of the action and the way that buying was sustained throughout the day. But today's another day, and we'll see what happens. You can see the transports also breaking out there back above that 50-day moving average, which is really important. We've got the PPO across all the major indices strengthening. Of course, the PPO is just based on price. It's not based on volume. It's not based on how you do during the day. It's simply based on where your 12 period EMA is versus your 12 or 26 period. That's the default reading of the PPO. So on a daily chart like we're looking at, what's that 12-day EMA look like versus the 26-day EMA? Well, when you start making a move like this, your 12-day is going to start to turn to the upside quicker than the 26-day. And as a result, you're going to see that PPO move back to the upside. But that's just part of the technical story. Again, what's the volume like during the move? What kind of rotation are we seeing during the move? All of those things are factors that we need to take into account. But all in all, very strong day. It's hard to argue with a day like yesterday in the market. As we look at the real estate group, that was the big winner yesterday. Utilities second. And I know first question out of most folks' mouths are going to be, what about this? Real estate and utilities leading a big advance. Well, it was one day. If we see this kind of behavior over the next month, going into the new year, that could be a warning sign. I mean, we'll see how it develops. Keep in mind, real estate and utilities both had been absolutely crushed for an extended period of time. So seeing that those groups come back with interest rates dropping the way they were yesterday is not a huge surprise. These were groups that were really beaten up by the higher interest rates. So we saw them coming back, but discretionary is in the third spot. And if you look at other areas like technology, which is a key growth driver of the market, technology went along for the ride. It wasn't like it underperformed. Technology actually, I think, was a little bit better than the S&P 500. I think technology finished up maybe 2%. You can see the S&P was up 1.91. So overall, the action yesterday I found to be very bullish. Looking at industry groups, the big leaders, you had renewable energy, and this is a group that has been really crushed going back to earlier this summer, maybe the beginning of August. Big drop. We saw this index drop from well over 400 down to below 250 in just 3 or 4 months. I mean, that's a real shellacking that this group took. But we saw a big bounce back up 11.4% in just one day. Of course, there's still a lot of overhead issues to deal with. I do like the lower lows and the higher PPO, though, on the renewable energy. So I think we're probably going to make a run for 300. We've got overhead price resistance there. We've got the 50-day moving average at 292. I think anything up in that 290 to 300 level is probably going to be met with some resistance. If it isn't, that would be a really good sign for not only renewable energy, but probably for some of the other technology areas and so forth, because this is an aggressive area. There's no doubt about it. When this group's going well, it can go well very quickly. And as we've seen over the last 3 or 4 months, when it's going poorly, it's really not good at all. Industrial and office REITs within that real estate group having a huge day, coming back up to the 50-day moving average, rising about 7 1/3%, finished at 97.40. The 50-day is at 97.79. So literally right up against the 50-day moving average, clearing that along with the October high close to 100. I think that's going to be the combination that we need to look at on the industrial and office REIT. And then finally, the furnishings area within the consumer discretionary group, furnishings up 7.27%. Another group that had been beaten down badly over the last 3 or 4 months, all of a sudden caught fire yesterday. Maybe it's just a dead cat bounce on this group, similar to what we see on the other two that I show. But it's nice to see some other areas that were beaten down coming back. And that, in a sense, is what drove the IWM higher yesterday. A lot of areas that had been underperforming were not performing well. All of a sudden, with the rates dropping like they did yesterday, breaking a topping head and shoulder pattern, breaking the neckline, I think all of that triggered buying in areas that were really being sold off hard as rates were going higher. So I like what's going on here. We're going to look at the 10-year Treasury yield next. I do want to talk a little bit about a couple of reports that were out this morning. First, of course, yesterday we had CPI. CPI came in better than expected. That was good news for the market. Today we have PPI coming in. This is October PPI, and the headline number was minus 0.5. expectation was for a rise of 0.1. When we strip out food and energy, the October core PPI was flat. It was expected to rise 0.3%. So again, I ask, where's the inflation? We've been seeing inflation dropping rapidly over the last year on an annual basis. And for the last 4 or 5 months, the monthly numbers are getting pretty darn close, especially the core CPI, getting close to the Fed's target. We don't need to drop much more than what we've been seeing over the last 4 or 5 months. So I think we're getting a whole different picture on inflation at this point. The market is expected, or most analysts are expecting, growth to slow in 2024 from where we are in 2023. If we've got growth slowing and we've got inflation coming back into the normal range, the Fed, there's only one way to go with interest rates, and that is down, not up. So I think all of that was playing into what we saw in the massive rally in the market yesterday, and some of the areas that were beaten down so badly jumping back up. Also this morning, retail sales out at 8:30. The expectation was for retail sales to drop 0.3%. They actually dropped 0.1%. So not as weak as the market was expecting. And if we strip out the vehicles, we were expecting to see retail sales, less autos, to come in at minus 0.1%. They came in at plus 0.1%. So I think we came in, we've got some pretty good news here this morning in terms of both retail sales and the producer price index. I think that is good for the stock market. We will see how it translates throughout the day. We had futures up this morning. They pulled back right after 8:30, and then they started to strengthen again. I will give you an update on that in just a second. The other report that came out this morning, Empire State Manufacturing Index, was supposed to be minus 3.0. It came in positive 9.1. So again, we got a little bit of a trifecta in terms of what I feel pretty good economic news. So let's take a look at what is going on with the futures right now. The diamonds, of course, they track the Dow Jones. Diamonds up about 0.2%. The spider, of course, tracking the S&P 500, up about 0.25%. The QQQ, tracking the NASDAQ 100, up nearly 0.5%. So we're getting a little bit more relative strength, at least appears maybe at the open on the NASDAQ. The NASDAQ, by the way, 387.10. And I'll show you this chart in just a minute. But the QQQ, the high back on July 19th was 387.42. 387.42. This morning, 387.10. So we are right on the verge of clearing the July high on the QQQ. So as far as the correction goes, the QQQ, the NASDAQ 100, has already eliminated all of that selling. We're right back to where we were when all those warning signs started to develop. Just a correction, folks. Right back to the high on the QQQ, and it has very, very little to go now. We may see an open here in about 15 minutes. We may see an open that is above that level. Now, what we want to watch for is maybe a reversing candle, because this could turn out to be more like a, let's go over to the NDX. You know, you may be looking at this as maybe a cup. It's not exactly a rounded bottom, but the same kind of a principle where you're going down, then you come back up. Volume on the way back up, pretty decent. And so if, for instance, we were to gap up and either take out this high or even just test this high and then pull back, remember it's option expiration week. When I went over this with all of our members at EarningsBeats last night, a lot of in-the-money calls right now because of this huge move up. So if you do get a reversing candle today, in the short term, I think you need to respect it. So if we gap up, then we come back down, have a filled, maybe a bearish engulfing candle, maybe a hanging man. You get up, gap up, fall back intraday, go back up, close it near the high, have like what looks like a hanging man. Sometimes that can be a precursor to a little bit more selling. A doji, could be anything like that. But just be aware, it is option expiration week. I always like to keep that in the back of my mind. but it is November and December. And if there are any exceptions to a lot of the seasonality rules that I follow, those exceptions tend to take place in November and December through the holiday period. So a little bit of a mixture of things. Make no mistake about it, I am bullish. It's hard to tell today, tomorrow, next day, whether the market's going to be up or down. But what I can tell you is I believe through year end, we go higher. We could be approaching all-time highs by the end of the year. That would not surprise me at all. And I do think the 10-year Treasury yield continues to drop. And then IWM, which was doing a little, actually, the IWM's flat right now. So the IWM, which showed such leadership yesterday, at the open today, or at least 15 minutes from the open, showing a little bit of relative weakness. Don't want to see that relative trend begin to drop again on the IWM versus the QQQ. We want to see that move back up. And I've got an interesting chart I'll show you, and I'll do that in just a minute. Didn't look at the S&P, but here's the S&P. So the S&P's got about another 100 points to get back up to that July high. So while the NASDAQ 100 is there already, the QQQ, the S&P 500 or the spider still has some more work to do, as you can see on that chart. All right, IWM, there's that Maribozu candle. I mean, you barely see any tail or shadow or wick out of this candlestick. That means that we opened on the low and we closed on the high. Buying all day long. If you looked at this on an intraday chart, I mean, we gapped up, we opened on the low, we closed on the high, and pretty much just buying all day long. Outside of a little bit of intraday, midday weakness, which didn't last very long, maybe 30 minutes here and another 30 minutes there, not much selling. You saw the recovery off of both of those. So finishing on the high of the day. I mean, today I would say I'd probably like to see the IWM, worst case, hold 176.50, which would be about $2 lower from where we closed yesterday. And I'm not saying it's going down there. I expect it to go down there. That's where we saw some selling go down to and the buying resume. So if we were to sell off early in the day, and sometimes the early morning, you can get a lot of volatility. If we were to get any kind of selling early in the session, I think 176.50 is a level that I'd like to see the bulls come back in on the IWM. And the relative chart that I was talking about, IWM versus the QQQ, I mean, we could go back. I'm going to go back like the last 30 days. And we'll put this on a solid line instead of a candle. This is what I'm talking about. I mean, we get these early morning moves in the IWM versus the QQQ, and then we haven't been able to sustain them. This is for the last month. Do you see a little difference yesterday? We gapped up, and then we kept moving higher, which is unlike anything we'd seen in the last month. So, yeah, I mean, I'd like to see this continue. Now, it seems like at the open, we're going to see a little bit of relative weakness. But if this is really turning the corner and we're going to see some of those small cap and mid cap areas do better through year end, we don't really want to see this start moving rapidly back down toward these lows. We might see a little bit of weakness, but we want to see intraday relative strength pick back up again. So that's something I'll be watching really closely today. Transports finally got that big move up through the 50. It had been trending lower for quite some time. Certainly not out of the woods. I think maybe we get a bottoming head and shoulder. That's something to watch. Here is the left side of the neckline, potentially. Here's your move down. That could be a left shoulder, could be the left side of a neckline, could be the head, the reverse head. And then this moving up, if we get to 15.2, that could potentially establish the right side of a neckline. Any kind of a move back down to around 14.6, that would be potentially a right shoulder. Just a possible pattern. I like when I'm looking at the charts and I believe we're going higher, I'm looking for a pattern that's going to kind of confirm a bottoming formation. And so a reverse head and shoulder would do that. And that's what I'm looking for. We've seen it in some other areas of the market. I wouldn't be surprised to see it here in the transports. All right, let's move on. I want to go over the chart of the day, and then let's hold off on the chart of the day. I wanted to show you the seasonality chart of the spider, the value side of the S&P 500, and then the growth side. So what we're doing is we're comparing the S&P 500 value to S&P 500 growth. And what I just went back a decade, just 10 years. You can see that on the slider down here. And the way you do this is you just grab this, by the way. You can take, there's 5 years. That's the default. You can see over the last 5 years, the end of the year has been pretty good for value. But even if we drag this back for an entire decade, which is close to the entire secular bull market advance from 2013, look at these four, look at the odds of value outperforming growth. And so, yes, yesterday, real estate and utilities did well, right? That they're more more value oriented type stocks. They pay dividends, and most of them are dividend payers, and they tend to do better when value is in favor. I'm just pointing this out because even though we've been in a secular bull market, starting in September through the end of the year, this is where the value portion of the S&P 500 has historically done better versus growth. So, there are a lot of folks last year when in December, when the QQQ went back down near the October low, everybody was saying, here we go again, we're rolling over. The NASDAQ, the growth area of the market, was just doing what it normally does, which was take a back seat to value. And so yesterday, with the real estate area moving up and utilities moving up, the first thought is, well, maybe, this is money rotating to defense. Maybe we need to be careful. But I just wanted to show this because this time of the year, that's kind of normal. We do tend to see money move more toward value. So if you look at the outperformance down here, and this is the average over the last 10 years, September, the SPY V outperforms the SPY G by an average of 1% in September, 0.4% in October, 0.6% in November, and 1.1% in December. So we've got 3.1% average outperformance by value versus growth last 4 months of the year. That's pretty remarkable when you consider that during the first 8 months of the year, only one is positive, April. The other 7 are all negative. July and August and May, all negative by 1.6%. So that's where we tend to see the growth names do well. Here is where we start to see more of the value do well. So again, I'm not going to be that concerned if money rotates into some of the areas that are more value oriented as we move through the end of the year. Growth isn't going to carry the market forever. Value stocks are going to participate from time to time, and it certainly could be from now through year end. So I just wanted to point that out because I know if we start to see some of these dividend payers, maybe the financials begin to roll, there's going to be a lot of questions coming up. Tom, you were bullish when growth was leading. Why are you not bearish when growth is lagging? Well, I'm going to remind you about this chart. Keep in mind, value does have history here of outperforming into year end. Now, if you want to see it visually, this is what we're looking like right now on the chart since September. Again, seasonally, we tend to outperform starting in September. So if you look at this chart, here's where we started September. Here's where we are now. We're slightly higher. But as I look at this, I see almost a bottoming head and shoulder pattern. Left shoulder, neckline, head, neckline, right shoulder, and up we go. So this is going to be a really interesting time to watch the IWM, some of these value areas like financials, even the industrials. If you see this ratio, SPY V versus SPY G, break this head and shoulder bottom, I think we could have a very, very strong oriented areas. Anyway, just pointing it out, trying to look ahead. It's not only about going over what we have seen the last week, 30 days, 60 days, 90 days, 5 years. I mean, anybody can call the market if we just look at what happened. It's all about trying to figure out what the market's going to do as we move forward. You've heard me many times, continually for 5 years, the last 5 years, through all these ups and downs, one constant, I have said every step of the way that this is a secular bull market. Not once have I said, well, maybe it's a secular bear. I said it in the middle of the trade war. I said it in the middle of the pandemic. I said it even before the cyclical bear market of 2022. I said we could go down to 3,500, worst case. But if we do, we're going to come roaring back out of it. I'm sticking to that. We're going higher. That's my opinion. Not a guarantee. I may sound like I'm guaranteeing it. I'm just confident. I like the signals I'm getting. I believe the market's going higher. I ignore all the naysayers. I ignore all the collapse. People like talk about crash, collapse, blah, blah, blah. Most of them are broken clocks, right twice a day or twice a year, twice a generation, whatever. I don't pay any attention in the long term. I follow my signals. Anyway, this is a pattern that's worth watching, because if we do get the breakout out of this pattern, I think that would be confirmation that maybe we should be skewing things a little bit more toward value and maybe a little less away from growth. I've already said I think stocks like Nvidia and some of these other, Apple, Microsoft, Amazon, I think some of these stocks that have been moving pretty good, so recently, I think in December it might be a different story for some of these stocks, and that's where the money could be rotating from, that fuels the value oriented stocks. So watch this ratio. I think this is going to be a big one. All right. Question came in, and we've got 4 minutes for the market open. Actually, I didn't do the. Let's go back and do the chart of the day. So for those of you who are interested in the chart of the day, go to EarningsBeats.com, both plural, EarningsBeats.com. I do a chart of the day. It's kind of a newsletter that we put out. It's the Earnings Beats Digest, 3 times a week, Monday, Wednesday, Friday, 2 paragraphs in a chart. Doesn't get much easier than that. Quick read. All it takes is a name and an email address. Hit that subscribe button. You don't see any place on here for a credit card. We don't require it. It's free. We're trying to give back to the community, teach, try to get stuff out into the public that you don't see much of on CNBC. Again, CNBC, their whole business model is about clicks. They need you to be watching their shows. They need you on their websites so they can sell their ads at a premium. That's how they make their money. They don't make their money by necessarily giving you great advice or great education. They make their money by scaring the heck out of everybody so that more people will tune in, because you want to see that train wreck. You don't care about the Boy Scout and the great thing the Boy Scout did. You want to see the train wreck. You want to see that train hanging over a cliff. That's what CNBC does, in my opinion. You can disagree with me. I don't care. But I think that they are all about clicks. They're all about, what's the word? Can't come up with the right word that I'm thinking of right now. But anyway, they're looking to try and make things as big a disaster as they possibly can. And sometimes they'll bring guests on. Don't get me wrong. They'll bring in some guests that think the market's going higher. But they sure do give a lot of time to those constant market crash types. Peter Schiff, Jeremy Grantham. I mean, these guys that just keep saying over and over and over again, we're going to crash, we're going down, get out of stocks, jump into gold, do all this. They probably haven't looked at a gold relative to S&P 500 chart in a while. It's been underperforming for, I don't know, 15 years, 12 years, whatever it is. Anyway, follow what we do at Earnings Beats, please. I mean, you don't have to agree with everything I say, and I'm going to be as objective as I can be. Do I lean bullish? Absolutely. Look at the stock market. Stock market goes up a lot more than it goes down. I'm always going to lean bullish. But if I see problems, I will tell you that there are problems out there. I'm not seeing any problems. I think this market's going higher. Anyway, chart of the day, sign up, and we'll make sure we get that out to you every Monday, Wednesday, Friday. Our chart of the day today, and by the way, before I go there, you can start, if you want to pay us, which is what keeps us in business, we certainly appreciate your support. 30-day no-cost trial, so you can try everything that we offer for 30 days, no cost. It's a great time because we have our fall special beginning probably in about a week. I don't want to give too much away just yet. We haven't announced anything, but it's coming, and it's coming up really soon. It's our best deal of the year. So now's a good time to try our service for free, because that fall special will not be around forever. Anyway, let's take a look at the chart of the day for today. Walmart reports tomorrow. So I thought this would be a good one to look at. Walmart has continued to move higher and higher. You know, Walmart is in the personal products index at stock charts. I think it could go into a number of different industry groups. I'm not sure personal products is the best area. I mean, it's got a grocery store, could be a Kroger's. So it could be in that area. It could be in the broadline retail. It's a little bit like a Costco and Target, and I don't know. It just seems like broadline retail might fit this. Anyway, it's in the group personal products. You can see it's been crushing personal products. And actually, if we pulled up, I'm interested to see what it is doing relative to the DJUS RS. No. Broadline retail. RB or VR? Yeah, RB. Walmart kind of just holding its own versus that group, but clearly in an uptrend. It really didn't pull back during this correction over the summer. And when the market started to take off, actually, even during that week in October that was really bearish for the market, Walmart continued moving up. And now as the market's gotten strong again, Walmart moving up. So Walmart's actually doing pretty well. And I expect a good report out of Walmart. Target, by the way, today crushed estimates. Estimates had been lowered, so it was probably a low bar, but they crushed estimates. Last time I looked, I think Target was up 13% this morning in pre-market. That was probably an hour ago, so that may have changed. But I think Walmart's going to have a similar type report. I think Walmart's going to have a really good number tomorrow. Now, it's been going up in anticipation, so maybe it's a sell-on news kind of thing. Just because a company reports good numbers doesn't always translate into higher prices. So we do have to be careful about that. All right. Let's go back and see what the market is doing, and we'll wrap up the show for today. We've got the Dow Jones Industrial Average up 0.4%, S&P 1/3 of 1%, NASDAQ same thing, NASDAQ 100 a little bit more than 1/3 of 1%, and a very, very slight move to the upside in the small cap and mid cap area. And there's Target, by the way. There's that 13%. So it did open up 13% this morning. I'm going to pull up that I want to pull up that SPYV and just see what it is doing today, if anything. Actually, it is showing a little bit more strength today. So if we go into you can see it is strengthening today. If this keeps moving up, don't lose sight of that possible relative head and shoulder bottom, that reversing head and shoulder bottom potential. You don't get it unless you break out. I'd need to see this up above about 0.705. And at that point, it would start adding further confirmation to some of the things that we're beginning to see. So keep all that in mind. That's it for me. We have a live trading room that starts in 27 minutes. That's available to any members at EarningsBeats. So if you do want to join us today for that no-cost trial, you can come in and see me again in 27 minutes, and we'll talk about some possible intraday trades today. All right, that's it. Have a great day, everybody. It was certainly a pleasure providing this show for you today. If you are watching this on YouTube, either live stream or recording, I want to thank you so much. Please like our video and subscribe to our channel. That's one way you can help us. If you're not in a position to subscribe to our service, you can certainly help us by watching our videos and liking them and subscribing to our channel. Have a great day. Happy trading.